Everything we've covered in this course culminates in this chapter. In Chapter 11, we learned how to evaluate a project's cash flows, where the cash flows for the projects under consideration are given. In truth, estimating the cash flows for a project is the hardest part of capital budgeting. In this first part of Chapter 12, we'll cover how to estimate a project's cash flows and which cash flows are relevant to our analysis. Part A includes determining which cash flows are relevant, how to handle depreciation, which is non-cash but relevant due to the impact on taxes and net income, and how to attack salvage values. Part B will cover risk analysis. At a very basic level, we're concerned with the firm's cash flows with the new project minus its cash flows without the project, the incremental cash flows generated by the project. Relevant cash flows. Changes in net working capital are relevant. Typically, at the beginning of any project, there's an investment in inventory or material or spare parts, which is a use of cash, but it's partly offset by a spontaneous increase in accounts payable. Interest and dividends are not relevant. The assumption is that all projects are funded by the same mix of debt and equity as the firm, which is reflected in the weighted average cost of capital. To charge a project with interest or dividend expense would be double counting. Sunk costs are not relevant. Any expense already incurred or committed are not relevant. For example, a pilot study done last year is not relevant to today's decision. Opportunity costs are relevant. Opportunity costs are the cost of an option not taken. These usually involve a physical asset, a plot of land that the firm owns that could be used for this project or sold. It's not free. The project should be charged with the next best thing that could be done with it, what we could receive for selling it. Externalities and cannibalism are relevant. Firms frequently build on a successful product with extensions to the line. The Big Bertha may lead to a Bigger Bertha, which may take sales away from the original. This loss of revenue is a cost to the project. Externalities can be positive. The iPhone 12s or 13 may generate sales of the iPhone 12 as it will be cheaper. Tax effects are relevant. Taxes are paid in cash and must be considered. Though depreciation is a non-cash expense, it affects income, so it impacts taxes, which are cash, so we need to understand how it works. The simplest method is straight line, where the value of an asset minus its salvage value is depreciated over a number of years equally. Firms can, and some do, use this method for reporting to shareholders, but they must use the modified accelerated cost recovery system for tax reporting. MACRS depreciates all assets to zero without any consideration for salvage value. Assets are assigned by the IRS to a class defining the recovery period in years. A half-year convention is applied so that all assets are assumed to be placed in service mid-year the first year. This leads to a 3-year asset formally being depreciated over 4 years. Under Modified Accelerated, the depreciation basis includes the cost of the asset plus any shipping cost and any installation expenses, the cost to put the asset in service. Under the new tax laws, a firm may deduct the entire expense in the first year, as we'll see in your sample project. Since Modified Accelerated Depreciation depreciates an asset to a zero value, when the asset is sold at the end of a project, there are tax implications. The net salvage cash flow is the cash received for selling the asset minus any taxes paid. You are taxed on the difference between the selling price and the book value. This equation is not in your textbook, but leads to the correct end of project net salvage cash flow. If the selling price is greater than book value, then you pay tax on the gain. If the selling price is less than book value, you recover tax on the loss. Let's walk through a sample proposed project and see how all the pieces fit together. First, the given data. Equipment needed will cost $280,000. Cost to ship and install is included. This is where the $280 depreciable basis came from. Under the new tax laws, the after-tax cost is $210,000. New project will require an increase in inventory of $25,000, a use of cash. Accounts payable is expected to increase by $5,000, a source of cash. So the net change in net working capital, $20,000. New sales of 100,000 units a year are expected at $2 a unit. Variable cost, 60% of sales. The project will last for 4 years. Note that this equipment is eligible for the new tax law's 100% depreciation at the time of purchase. It's expected to be worth $25,000 at the end of the project. Tax rate's 25%, cost of capital 10%. Note that the project has a definite finite life, 4 years. In capital budgeting, regardless if the project is expected to go on forever, it has a life. The assumption is that at the end of the project, all equipment purchased will be sold for salvage. In addition, inventories and accounts payable will go back to pre-project levels. Thus, the change in net working capital will be recovered. To begin our analysis, we have to calculate the operating cash flows, sales, revenue, and cost, compute changes in net working capital, and calculate terminal cash flows, recovery of net working capital, and net salvage value. The timeline lays out the general plan: initial cost, equipment and net working capital, operating cash flows, annual income and expenses, terminal cash flows, salvage and recovery. We've already looked at all the components of the initial cash flows. The net change in net working capital considers the increase in inventories as a use of cash netted against the increase in accounts payable as a source of cash, for a net change of $20,000. The initial outlays for equipment include the equipment, $280,000 after tax, $210,000, the change in net working capital, $20,000. So the total outflow at time zero, $230,000. Let's start putting it all in a pro forma statement format. Revenue, 100,000 units at $2 apiece, $200,000 each year. Operating costs, 60% of revenue, $120,000 each year. There's no depreciation since the firm can deduct the entire expense in year zero. Revenue minus cost, EBIT. Taxes is 25% of EBIT. Subtract taxes. Add back depreciation. It's a non-cash expense that must be considered for tax reasons, but we're solving for cash flow. It's included here as a reminder of the add back, even though we have no depreciation. Operating cash flows are the bottom line. Let's look at terminal cash flows. We recover all investment in net working capital in the final year of a project, so the $20,000 is an inflow in year 4. We were told that the equipment would be worth $25,000 at the end of the project. Since it was depreciated to zero book value, the entire $25,000 is a taxable gain at 25%, $62.50 tax. So the net salvage value, $25,000 minus $62.50, $18,750. Our terminal cash flow is $38,750, and the terminal cash flow is added to the operating cash flow. Let's review some of the relevant and irrelevant cash flows we may be presented with. Financing costs are not relevant. They're accounted for in the weighted average cost of capital, including them, double counting. How about a $50,000 improvement made last year? No, sunk cost. It's not relevant to the analysis of the project going forward. What if the facility planned for the project could be leased out for $25,000? This is an opportunity cost and it is relevant. The project should be charged with the cost of the next best alternative. In this case, it would be the after-tax operating cost, $18,750. What if this new product cannibalizes from the firm's current product line? This would be a cost to the project. Remember, we're concerned with the firm with the project minus the firm without it. Externalities can be complements that have a positive effect. Putting all the numbers we've come up with together on a timeline, we have the values we'll use in the cash flow worksheet to find NPV. NPV, a minus $13.34 million. IRR, 7.5% versus a cost of capital of 10%. MIRR, 8.4%. Payback, 3.5 years. With these results, the project is a no-go. This shows the top part of an Excel worksheet to set up and solve our project analysis. This displays all the given data. In the real world, this is how you'd want to set up this type of analysis. Putting all the given data at the top keeps it together so that if anything changes, you can change it in one place. This details the depreciation and after-tax salvage value calculations. And this is the pro forma cash flow portion. Don't forget, depreciation is added back, just a reminder. Net working capital is recovered. The bottom line recaps the value to be used to find NPV and IRR. And finally, our calculations. NPV, IRR, and MIRR are Excel functions, and they're shown to the right of the values. Payback and discounted payback can be found using logical if statements as shown at the bottom. This shows the whole worksheet with the various sections highlighted. All background data at the top. Note the red line. Everything below the red line should be picked up from or calculated from something above the red line. Next comes the depreciation section, after-tax salvage value, the pro forma cash flow, and finally the Excel functions. This Excel example is posted with this lesson for a closer review. A couple of final topics in this section of Chapter 12. First, replacement. If this were a replacement project, as in replacing a piece of equipment, the analysis would change. Old equipment sold, new purchased. Inflows and outflows with tax effects. You'd lose the salvage value of the old equipment, opportunity cost of the replacement. Depreciation would change. Lose the old, gain the new. Incremental cash flows would change. A replacement project is very common, yet a bit more complex than a straightforward new investment. And for that reason, we work to understand the general concept of capital budgeting using a new project first, leaving replacement analysis for later lessons. Going back to our project pro forma, what if we expect inflation to increase by 5% every year of the project? This will bias the NPV downward since the cash flows, as originally estimated, do not consider inflation. But the cost of capital is based on nominal rates and does include inflation. So NPV will be biased downward, not the result we want. So we need to build inflation into our forecasts. To demonstrate further, looking at the basic NPV equation, cash flows in the numerator are real, no inflation. Yet the weighted average cost of capital in the denominator is based on nominal rates, with inflation included. Nominal rates are greater than real rates, and the cost of capital is a nominal rate, but our real cash flows do not include inflation. Result? Downward biased NPV. Two ways to adjust. We could adjust the discount rate to remove inflation. This sounds like the easiest approach because you adjust just one variable. But it implicitly assumes that inflation affects all line items the same, and it doesn't. Depreciation, for example, isn't affected at all. The better approach is to make adjustments on a line item basis. Let's make the 5% adjustment to our project cash flows. Revenue and operating cost increase by 5% each year, but depreciation doesn't change. The result is an inflation-adjusted NPV of a positive $10 million. A huge difference from the negative $13.34 million without the inflation adjustment. Here is the inflation-adjusted pro forma in Excel. This is the second tab in the exhibit posted with Chapter 12, Part A. This ends the first part of Chapter 12. In the second part of Chapter 12, we'll end with risk analysis.